Today we will discuss on the topic Accounting Standard 1 Disclosure of Accounting Policies. But before getting into the topic, firstly we should know few basic concepts regarding to financial statements. What are the components of financial statements? Who are the users of the financial statements and their decision making process? How it should be prepared? First of all, the financial statement includes not only profit and loss account and balance sheet, but it also includes cash flow statement and notes to the accounts. The notes to the accounts discloses the information relating to accounting policies and accounting assumptions based on which the financial statements had been prepared. For example, the notes to the accounts contains method of depreciation, method of valuation of closing stock, the stock valued at cost or net realizable value, etc. Next, uses of the financial statements. Uses of the financial statement includes shareholders, then lenders, then government, and then management of the company. The shareholders includes both existing shareholders and also investors who are going to invest in the company. The shareholders use the financial statements whether they can invest further or to drive their money somewhere else to safeguard their investment, because the financial statement always reveal the financial results and also financial position of the business. It will help the existing shareholders and also future investors if they can invest further or not. The next person who is using the financial statement is lenders. The lenders are those who lend either goods or services or money to the concern. The lender who lend goods or services will be termed as creditors. The one who lends money may be either bank or financial institutions or debenture holders. The lenders will use the financial statements whether they can lend the money for the business or should they stop their lending. And the next user is government agencies. The government uses the financial statement to ascertain whether the concerned paid the taxes promptly and the computation of profit or losses is calculated properly or not. Another user of financial statement is management of the company. Hence, the financial statements are prepared not only for the top management of the concern but also for other users. The board of directors and the management of concern use the financial statements to compare their results with their competitors, and also they will compare themselves with the past performance, like what is the last year sales, what is the current year sales, what is the last year profit, what is the current year profit, whether it is reduced, if it is reduced means what's the reason. These kind of comparisons can be done by management of the company. The accounting standards are used for preparing the financial statements in an uniformed manner and structure which enables the comparison. Next, AS1 Disclosure of Accounting Policies. This accounting standard deals with accounting policies and accounting assumptions. First, we will look into accounting policy. It refers to accounting principles and the method of applying those principles. The best example for explaining accounting policy is depreciation. The depreciation should be charged by all the firms which are having fixed assets. Only after charging depreciation, the firm can arrive at the true and correct profit or loss of the business. But it is the choice of the management to choose their own method of depreciation. It can be charged either through straight line method or written down value method or annuity method or sinking fund method, etc. Then what are the purposes of the accounting policy? To have a better understanding of the financial statements, and then to have a uniformity between the firms, and that uniformity enables the comparison. Next, compliance with law, and the last one is ICAI requirements. Next, we will glance through what is meant by accounting assumptions. Accounting assumptions are the basis on which financial statements are prepared. Whenever these financial statements are prepared, they are prepared based upon the following assumptions. The first assumption is going concern. We have already read in our earlier stages like 11th standard or foundation that men may come, men may go, but the company remains forever. But the truth behind those words are the business shall stand for longer period of time. For example, let's say if you are going to start a business, what is your primary objective? Few guys may say that primary objective is profit. Yeah, that is partially right. You may think why it is partially right. Let me explain. Earning profit is one of the objective of the business, but it is not the only objective of the business. The primary objective of the business is that it should be run for longer period of time with earnings of huge profit. This is the ultimate aim of all business houses. Even we will wish that our business should be continued by our daughters and sons. This is the concept of going concern. So, the financial statement also be prepared based upon this assumption that the enterprise will go forever. Next assumption is consistency. Accounting policy should be applied consistently without changing them frequently. But it does not mean that it should not be changed at all. It can be changed. If we think that one of the methods of applying accounting policy is better than another method, we can prefer the better one. For example, I already explained accounting policy with the example of depreciation. We can use the same example to understand this assumption. The enterprise is following straight line method of depreciation in the books of accounts. If the management have a thought that written down value method is better to show the true and fair view of the financial position of the concern, means they can change the method from straight line method to written down value method. So when we have a professional judgment that the change in method of accounting policy will show better picture of the concern, then the method can be changed. Last and final assumption is accrual. The revenue and expenses should be recognized based upon what should have been received and what should have been paid. Accrual is the, in respect of revenue, always worries about what should be received instead of what is actually been received. Accrual in respect of expenses always worries about what should be paid instead of what is actually been paid. For revenue, we will explain this accrual concept with credit sales and advance from customers. So, what is meant by credit sales? Credit sales is the goods being sold to customers for credit, and the customers will pay their amount only at the end of the credit period. In this case, even though the amount being not received for the goods which had been already sold, it is recognized as revenue because it should have been received by the business, but it is not yet received by the business. Next one is advance from customers. Advance is the amount received from the customers even before the sales had been happened. In this case, though the amount being received, it should not be recognized as revenue unless the sales being made to the customer. In this case, the amount should be received only after the sales, but it is received before the sales. So, it should not be recognized as revenue even though the amount being received before the occurrence of sales. Next, we will move towards expenses. It can be explained with outstanding expenses and prepaid expenses. What is meant by outstanding expenses? Outstanding expenses are the expenses which should have been paid but not paid by the enterprise at the end of the financial year. Though these expenses had not been paid, it should be recognized as an expense based upon the concept of accrual. Here comes the prepaid expense. These are the expenses which are not yet due but paid earlier by the enterprise. Though this had been paid, since it is not false due, it should not be recognized as expense based upon the concept of accrual. We can test the outstanding expenses and prepaid expenses concept with salary. First case. Salary being paid for 10 months instead of 12 months. So, 2 months salary is outstanding. So, in P&L, we will show 10 months salary paid plus 2 months salary outstanding, which put together 12 months salary. Total amount of salary should be shown in P&L is 12 months salary and not the 10 months salary. The 2 months salary is shown as outstanding added along with 10 months salary paid. So totally 12 months salary being charged in P&L. In the second case, let's assume 13 months salary being paid by the concern. As per the concept of accrual, only 12 months salary should be charged in P&L. So the total salary paid, 13 months salary less 1 month salary which is prepaid, that's the net effect of 12 month salary. That's what should have been paid, that is 12 months salary being charged in P&L instead of 10 months salary or 13 months salary in both the cases. Next we are going to see what are the points to be remembered for selecting accounting policies. The first thing we need to consider, the accounting policy we are going to choose for the preparation of financial statements should give the true and fair view of the financial statements. The other aspects of selection criteria are prudence, substance over form, and then materiality. First, prudence. Prudence is one of the conservative approach in the accounting treatments. It implies that profit should not be anticipated or overstated, but the provision should be made for all known liabilities and losses. The future or unrealized profit should not be recognized, but the future or unrealized losses should be recognized immediately. For example, we will explain this with the help of closing stock. Situation 1. Cost of goods is rupees 100, future expected selling price is rupees 110. In this situation, the future profit is rupees 10, but that profit should not be recognized since it is not a current profit and also it is a future profit which may or may not happen in the future. This is the concept of prudence. Situation 2. Cost of goods is rupees 100 and the selling price of goods is rupees 110. There is a profit of rupees 10, but it is unrealized profit because these goods are not yet been sold. It is still within our ownership. So this unrealized profit should not be recognized. And also it is as per the rule that goods should be valued at cost or market price, whichever is lower. That is rule is also the part of prudence. Situation 3. Cost of goods is rupees 100 and the future expected selling price is rupees 90. So there is a future loss of rupees 10. Even though the loss rupees 10 is futuristic, it should be recognized immediately. So thus the future profit is not recognized, but the loss had been recognized immediately. Situation 4. Cost of goods is rupees 100 and the selling price is rupees 80. So there is a loss of rupees 20 and the same loss should be recognized immediately. It can be done by valuing the goods at the selling price instead of cost. Since the selling price is lower than the cost of goods, thus the rule of closing stock, which should be valued at cost or market price, whichever is lower, is still based upon the concept of prudence. Final part is disclosure requirements. Each and every AS ends with disclosure requirements. That is how the concept of this accounting standard should be disclosed in the financial statement of the concern. Here we are going to see what is the disclosure requirement for accounting policy and accounting assumptions. So first, accounting policy. All the accounting policy which are involved in the preparation of financial statements should be disclosed in the notes to the accounts so that it is easy for the users of the financial statements for better understanding. If there is a change in accounting policy, the effect of the change for the current financial year and also future period should be clearly reported in the notes to the accounts along with its quantification. Finally, the accounting assumptions should be disclosed in the following manner. If the accounting assumptions are followed properly, then there is no necessary to disclose that the accounting assumptions is followed. but at the same time, even if any one of the accounting assumptions is not followed, then the unfollowed assumptions should be mentioned clearly in the notes to the accounts. Now we are going to see the past exam questions in this AS. What are the purposes of accounting policies? What are the fundamental accounting assumptions and its disclosure requirements? Write down the concept of prudence and materiality. What are the disclosure requirements as per AS1? Thank you. If you have any suggestions and doubts, please post those suggestions and doubts in the comment box. This is Anand Kandasamy signing off.